What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In today's video, we're going to go over a massive corporate accounting fraud that contributed to the fall of a Japanese technology giant. Many large-scale corporate frauds are caused by incentive structures that incentivize managers to hit quarterly goals. This can lead executives to make up revenues or cover up expenses to increase reported profitability. This short-termism frequently leads to cases where executives do things that make numbers look good for one quarter at the expense of future quarters. For example, we've seen companies report revenues in one quarter that actually didn't happen until the next quarter, or report revenues for deals that haven't been closed yet. In these cases, revenues aren't necessarily being truly fabricated, but brought forward into the previous quarter. Other times, revenue and expense numbers are completely made up. In 2015, it was revealed that the Japanese technology and industrial conglomerate Toshiba had fabricated operating profit numbers for several years. It was seen as a scandal that threatened Japan's global image. The total amount of profits that had faked was around $1 billion. The scandal was perpetrated by several high-up executives at the company, who all knew what was going on, and created a company culture pressuring colleagues to go along with it. In this video, we'll talk about what they did and what it meant for both Toshiba and Japan. Toshiba is a large Japanese technology company that has come to symbolize Japan's technological abilities. It is a diversified business that engages in producing everything from power systems and lighting equipment to semiconductors and batteries to computers and appliances. It was founded in the 19th century as a manufacturer of telegraph equipment. In the mid-20th century, it expanded rapidly through both organic growth and mergers and acquisitions. In the US, it was especially recognizable in the TV market with their cathode ray tube TVs. But in the early 2000s, this business started to die and eventually led to large losses for Toshiba. They closed their CRT television business and invested in a flat-screen TV technology called SED. This technology never caught on, dominated by LCD and eventually LED TVs. The TV business was not the majority of the company's revenue, but other parts of the business also started declining in the early 2000s and 2010s. Toshiba was hit hard by the 2008 global financial crisis. It's a highly diversified conglomerate, but it nevertheless was very dependent on industrial demand. Starting in 2007, it made large losses, which did not improve at the end of the recession. By 2011, the losses became even harsher. The multi-year slump in business was a major embarrassment to the proud company. It caused an immense amount of pressure within the company to do whatever necessary to maintain the outward profitability of the company. In May of 2015, Toshiba announced publicly that it discovered and was investigating an accounting scandal that affected the previous 3 years of financial statements. In the end, it was found that the company actually inflated profits over the previous 7 years. The scandal was wide-ranging and affected many different divisions within Toshiba. In the power systems business, there were 7 instances found where major projects had their financial numbers fabricated. One of the earliest such instances occurred with a project starting in 2007. This project involved producing boilers, turbines, and generators for a client, with a contract worth 54.5 billion Japanese yen. That's close to $1 billion. Even at the beginning of the project, Toshiba estimated that the cost of the project would exceed the proceeds, leading to a net loss. But they went ahead with the project anyway. The losses of billions of Japanese yen were inexplicably not recorded for many years. Accounting standards would dictate that a provision for losses on the project be recorded starting as soon as the deficit was discovered. It was found by the investigation that a high-up executive denied approval for recording the loss provisions in order to inflate earnings numbers for several quarters. In another project, a US-based division of Toshiba received a contract for $130 million to provide electric equipment for use in a subway system. Toshiba was to design and manufacture the electric equipment. After a year and a half, it was clear that the project was going to lose money for Toshiba. They estimated that the total cost of the project would be $207 million, about $80 million more than the $130 million that they were being paid. The investigation found that the CEO and CFO wanted to avoid recording a net loss for the project, and thus prevented the recording of any provisions for losses. The rest of the company was not doing well at the time, and if they took loss provisions, they likely would have had to report a company-wide loss. In order to prevent this, they postponed disclosing the large losses on the project. In other projects, Toshiba used another financial accounting strategy whereby at the beginning of a project, they report cost-cutting measures that they took. These cost-cutting measures theoretically improved the profitability of the projects. This allowed Toshiba to use them to report profits during the quarters when the cost-cutting was taken, but before the projects were actually completed. In many projects, these cost-cutting measures were overly optimistic, overestimating the reductions in expenses by hundreds of millions of yen. By the end of the projects, when the actual costs were recorded, the fake cost cuts would have to be realized as larger losses, but it was another way for Toshiba to delay reporting losses. A final accounting strategy that Toshiba used was overstating the values of their inventories. They would increase the price of their products at the end of fiscal quarters. Even though most of their actual sales were for lower prices before the price increases, at the time that the financial statements were prepared, the prices on paper at least were higher. That allowed them to record higher values of their inventories. That effectively gave the impression that they were more profitable during that quarter than they actually were. In the end, these schemes distorted the true costs, revenues, and ultimately profits of Toshiba from 2008 through 2014. Starting in 2011, Toshiba used a combination of many schemes to avoid posting losses. But it became increasingly difficult to use these schemes to avoid financial disappointments on Wall Street. Most of the accounting strategies only delayed reporting losses. Unprofitable projects were put off until future quarters before they were reported. By 2015, the amount of delayed reporting of losses became too much to handle without risking outside analysts deducing that something was going on. So Toshiba preemptively announced publicly that it would have to restate its financials. The total amount of profits that had been fabricated came to be $1.2 billion. Later that year, Toshiba's CEO Hisao Tanaka stepped down. In addition to Tanaka, 8 other senior executives also resigned. This followed the Japanese finance minister saying that Toshiba risked causing Japan to lose the trust of the international business and finance community. In 2017, after several more money-losing quarters, Toshiba was removed from the Tokyo Stock Exchange's first section and added to the second section. The first section is a designation reserved for the most admired and profitable companies listed on the Tokyo Stock Exchange. One particular hard requirement for being on the first section is having a positive shareholder equity value. Toshiba at that point had a negative shareholder equity value of more than $5 billion, meaning that the value of all of its debt and liabilities exceeded the value of all of its assets by $5 billion. They also were having problems filing their financial statements on time. Around 2017, Toshiba was in the process of selling off its nuclear reactor business, which was losing millions of dollars a year. In relation to the divestiture, they were in disagreement with their auditor as to how to recognize the losses on the deal. Since Toshiba doesn't have a great track record of properly recognizing losses, this was a major point of contention with both the auditor and the Tokyo Stock Exchange. In 2017, Toshiba lost 228 billion Japanese yen, or a little less than $3 billion. Last year, in 2020, Toshiba made something of a comeback to profitability, with a 251 yen profit. After divesting some of its older, money-losing businesses, it looks like the company may be able to finally be on the road to return to its glory days. During and after the financial crisis, Toshiba's highest-level executives put immense pressure on the rest of the organization to improve financial results. They were hit hard by the recession and wanted to do anything necessary to report good numbers each quarter. Although the CEO, Hisao Tanaka, denied ever explicitly telling his subordinates to fabricate profit numbers, the pressure originated at the highest levels. When losses were not recorded, the CEO and CFO knew about it and didn't do anything. On paper, Tanaka didn't technically order the fraudulent accounting and never faced any charges. But this scandal will go down in history as a case where pride and pressure led executives to do things that ended up blemishing a company's 140-year history. Alright guys, that wraps it up for this video. If you like the content, make sure to smash the like button and subscribe so you don't miss future videos. Also, leave a comment saying what you think about Toshiba's accounting fraud. In the meantime, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.